So Steve, it's been a little while since we've got together. Last time I think you spoke was mid-December. So we finished the year with a little volatility, but not too much. However, as people came in from the New Year holiday right into the first trading day of the month, January started off with a pretty volatile capital markets environment. So can you walk us through how closed-end funds performed in light of some of the capital markets volatility?
Sure. I think the last update was right before Christmas, and I think we had a nice Santa Claus rally going into year end. And then as the calendar year turned, there was an abrupt sell-off. The market sold off pretty hard. The S&P bottomed out at about down 9% intra-month, and closed-end funds performed poorly as well. The end-of-month numbers weren't too bad. The S&P 500 was at about 5% loss. High-yield bonds were about 2% loss. And closed-end funds were down about 2.5% loss, which on a relative basis isn't bad, but certainly not what closed-end fund investors typically expect. Usually after a sell-off in December from excess supply due to tax loss harvesting, closed-end funds tend to bounce back in January. But when the market drops the way it does, it's truly a risk-off environment. And closed-end funds really are a risk-on asset. For the most part, these are bond funds with corporate credit or equity funds which have traditional beta. And so therefore, in this type of market, when investors are truly rushing for the exits, closed-end funds were down similar to the broader market. But what was interesting was that discounts basically ended where they started. The beginning of the month of January, we had an 8% discount. At the end of the month, we were right around 8% too.
Steve, any distinction between sort of equity and fixed income performance, or was this just a broad-based sell-off?
Definitely. I think what's interesting is that people group closed-end funds as just one asset class, when underneath you've got obviously equities, taxable, fixed income, and muni bonds. And what was interesting was that the market is truly starting to differentiate between the closed-end funds that they want and the ones that they don't. For the month of January, muni closed-end funds did very well. The average price was positive, although just slightly above zero, but discounts remain very narrow. And I think that's interesting and something to keep in mind, which is for those investors that are frustrated with wide discounts, it's important to realize that munis, which are about half of the market, were, as recently as mid last year, you had discounts in the low teens, and a lot of those discounts have narrowed to mid to high single digits. And so when investors like an asset class, like they do munis today, discounts narrow because retail investors want to own more. Whereas equities and taxable fixed income, not many retail investors are looking to increase their allocations today, which is why discounts are wide. And so since this is a retail market, it's not going to be until retail investors come back to that market that those discounts narrow. And so for the distinction, yes, there is a distinction which has taken a while to occur, but there is a strong preference for tax-exempt income. And despite the overall volatility in the closed-end fund market, those discounts remain narrow and showed that when investors have a preference for an asset class, those discounts can narrow substantially.
So is it fair to say that the performance of munis, both from a discount narrowing and from a total return standpoint, is an example of what can happen to some of the other asset classes if investors, retail investors, sort of get behind that from liking that asset class?
Definitely. I think when you think about closed-end funds, there's really two ways to own the asset class. One is to own it opportunistically, as RiverNorth likes to do for our strategies. And the other one is to essentially chase fund flows. And when fund flows are positive, discounts will continue to narrow, and oftentimes they can go from discounts to premiums. In the muni space today, a lot of that seems to be occurring. Discounts are narrowing to levels that don't seem that attractive given the relative volatility that they could incur. But on the taxable fixed income and equity side, if you think about owning an asset class and having that beta in your portfolio already, it makes a ton of sense to own that asset class at 90 to 85 cents on the dollar. Intra-month, we had an opportunity to buy great fixed income funds at 15 to 20% discounts, equity funds at 20% discounts, which we really haven't seen for quite a while. And so when you look at your portfolio, we've said this a number of times, just think about the beta you're already taking and realize that you're starting off at a huge advantage by owning a discount that's substantially wider than its historical average.
So Steve, I get the pitch that an investor might as well take similar beta exposure through a discounted closed-end fund, but that's sort of one side of the equation. Talk a little bit about the discount opportunity from here. We've been on the record for the last few months talking about, discounts are kind of in the 90th to 95th percentile from a historical basis. But what's the pitch from a discount perspective? What should attract investors about just the ability for discounts to narrow from here?
Again, when you think about buying equities or taxable fixed income, for the most part, it's a risk-off environment. People aren't looking to add equity exposure. People aren't looking to add taxable fixed income exposure. When I say people, I'm talking about retail investors. This is a retail market. And so contrarian investors, which I would call institutional investors in the space, and those that are looking to get opportunistic investments, cheap exposure to beta, you're basically along for the ride. You can't control when discounts are going to narrow for the most part because you're relying on retail investors to buy up the closed-end funds and narrow those discounts. And so it's oftentimes impossible to predict when discounts at an aggregate level will narrow, but that doesn't mean that at the margin closed-end fund discounts can't narrow by asset class. And so if you're picking an asset class that you think will perform well and you like the beta of the asset class, then if that performance plays out, the discount should narrow as other investors appreciate the return of that fund and then start to follow, essentially performance chase that asset class.
Steve, thanks for your comments this month.
Thank you.
One note to our viewers. For our February market video, which we will shoot in March, we would like to know what's on investors' minds. So if any investors viewing this video have questions they would like for Steve and I to answer next month, please send an email to info@rivernorth.com with your question, and Steve and I will take the best 6 or 8 questions to review in our next video. Thank you.